and welcome to Season 2 of the Recruitment Leadership Podcast, hosted by Alison Humphreys. The Recruitment Leadership Podcast is here to help those in the recruitment industry gain awareness and understanding on the hot topics faced by those in the business of hiring people. In each episode, Alison Humphreys is joined by a fellow expert to offer professional knowledge, insight and advice on the biggest subjects affecting recruitment businesses. In this season, we're focusing on the fundamentals of financing your recruitment business, including the questions commonly asked and the different scenarios you and your business may find yourself in. It's the podcast to listen to for recruitment business frontrunners seeking expert information from industry-leading advisors. Welcome to the Recruitment Leadership Podcast.
Hello and welcome to Season 2 of the Recruitment Leadership Podcast. Thank you for joining us. I'm Alison Humphreys. I'm the MD of Recruitment Leadership, and for those of you who haven't listened to any of our previous podcasts, Recruitment Leadership is a business that works with owners and directors of recruitment businesses throughout the UK to help them achieve their ambitions. So whether they're in startup mode or even at the other end looking at a significant business event. For Season 2, I'm delighted to be joined by Nick Russell, who is the Commercial Sales Director of Sonovate. Sonovate is a FinTech provider for the recruitment and consultancy sector. Something of a disruptor actually, in that it doesn't merely offer funding but also the technology to support growing recruitment businesses. So welcome Nick, we're very pleased to have you join us.
Thank you for having me, good morning.
So for our first episode on business financing, Nick and I are going to be talking specifically towards startups and newer businesses in the recruitment sector. So you may have been going for under a year. It may be that you've been operating a lifestyle business up to now and have changed direction. Nick, the time from startup to seeking third-party funding from organisations like Sonovate has shrunk quite dramatically for recruiters over the last 10 years. Can you give us your thoughts on why that would be?
I think it comes down to two main factors, being technology and demand. There was 8,500 agencies who registered in 2018, which is a 46% increase on 17. And I think that the finance world has reacted to this. The audit trail, especially for a contract or temp recruitment company, is very desirable to the invoice finance sector. There's a clear deliverable there of a signed timesheet, which is very fundable as it's so robust from a funding perspective. So I think with the influx of technology and funders, they have an access to a very buoyant market of new start recruitment companies. And because there's so many of them forming and the ease to form and barriers to entry is a lot lower, I think that people are being approached, or on the converse, the ability for the recruitment company owner to access a funding partner such as a Sonovate is very easy now.
That's interesting what you just said. Given the huge number of startups and the low barriers to entry in the industry generally, you said that nevertheless funding invoices was quite an attractive proposition for providers of finance. So those two things might seem to our listeners to be slightly contradictory. Why is it such an I can see there's a growth market there, but why is it an attractive commercial arrangement for financing organisations?
Because the main asset in a recruitment company is their debtor book, so in short their invoices, and it's how can a funder ring fence themselves around the funding of that invoice at 85, 90 or in a Sonovate world up to 100% of the invoice. The signed timesheet is collateral. An authoriser has said that the contractor or temp has completed that work to a satisfactory standard, proceed to invoice. So it's a very robust audit trail which a funder is very happy to put their name to and aggressively at high prepayment levels fund. Other deliverables and other products outside of recruitment can potentially have the impact of credit notes or of know what we call proof of delivery or sign off. So it's a very desirable sector to fund the contract side and permanent to an extent. It's another conversation obviously, and it's a different deliverable, but it's kind of belt and braces, the signed timesheet.
Right.
Or we'd like to think anyway.
So at a very basic level, with the signed timesheet, it's a lot less easy to argue that the service hasn't been delivered than, say, paying for something that a courier company claims to have delivered but is in fact thrown out the back of their van.
Yeah, it's in the invoice finance world classed as a proof of delivery. Okay. So if somebody has ordered 10 chairs to be delivered and they get delivered, but nobody signs for them, and when they open the box there's 9 chairs there and 8 of them have got 3 legs, they're not going to pay for their chairs, are they? Mm-hmm. If a contractor or a temp works there 40 hours for the week at the agreed rate, and they turn up for all those 40 hours and the authoriser authorises the 40 hours of work, it in theory can't be disputed. Of course, if it was that easy, then credit note dilutions, etc., and rebates would never happen. Mm-hmm. But as a article of audit, it's a proof of delivery, which is pretty strong. Right.
So we've got a good proposition for financiers, and therefore it's facilitating more new people entering the recruitment market, arguably.
Yeah, absolutely. You can, as we all know, go on the internet now and put in finance for recruitment companies, and there'll be a host of providers, advisors, brokers and funders who will come up. But on the converse as well, companies such as Sonovate are aware of the growth in the new start contract market, the low barriers to entry, and through technology, for example, you can have a facility set up in 24 hours.
Mm-hmm. Wow, that's impressive. Okay. So I work with a lot of businesses that originally set up as a lifestyle business. And for obvious reasons, those people start with permanent recruitment. Usually that's their area of expertise, but it also brings in money quite quickly. But many of the businesses that contact me are frustrated because they're now stuck on this hamster wheel of permanent invoicing, which means the clock goes back to 0 every month, every week even, and they are really keen to break into a piece of the sexy action, which is temporary and contract and all those sustainable visible revenues, but they don't quite know how to get there. So what's your advice for those organisations? What are their options and what might hold them back?
Firstly, and it's a good question this, and a very topical debate that I'm sure some of the listeners will agree with me and some won't. A lot of these new start business owners, or even if they're not embryonic, they're a couple of years in, but they are solely perm, they're afraid to seek finance because they've been brainwashed previously by the large RPOs or corporates that they've worked for, that you can't go out and set up a contract book. How would you finance it? How are you going to pay your contractors? And they listen to this, and it's a way of retaining staff, obviously. So they start doing perm, and perm, as we know, can be very volatile, but it's also very lucrative, and there's no cost of sale. You don't have to pay the contractors' wages, etc. It's debatably slower pace than contract, but it's all profit. And if you are a single recruitment owner working on your own, and you have a good month, it's a really good month because you've got no overheads. So the attraction of contract is obviously it's recurring income, isn't it? So if you get a number of contractors out, and margins, as we all know, can massively vary, but it's cash flow for you, isn't it? Each month you can forecast, I've got 10 runners out, and that will yield me a return of X. So my NFI will be Y for this month. Your perm is kind of the icing and the cherry on top, isn't it? And if you can get a nice blend of contract to perm, then in theory you should have a very successful recruitment company. So they don't believe that they can get the finance, some people naively, to fund that contract book. How wrong are they? Going back to our previous conversation, it's a very desirable asset for us to fund. So they don't believe that they would want to give security, a lot of which there's probably over 100 banks, funders, and niche invoice finance companies and tech companies or FinTechs, which we are, that want to take a lot of security, that want to commit you to a minimum fee for the year, that want to tie you into a lengthy contract, that want to impose fees for you not performing to your forecast levels, etc., which is quite archaic. The invoice finance world for me hasn't particularly moved on. Some lenders have. From a Sonovate perspective, we want to educate company owners on how can they access a flexible solution which is very highly geared, which enables them to scale, but also isn't prohibitive that you have to pledge everything from your company, i.e. it's not an all turnover agreement. You don't have to use this if you don't want to. You can be selective on the debtors that you do or don't put through. We're not committing you to an 18-month or 12-month contract. We're not taking personal security. So it's almost a plug and play facility should you need it.
Right.
Now,
so just to be clear for some of our listeners who've got no experience of this, you don't have to, it's not an all or nothing arrangement. So it would be possible to say, I only want to put half my debtor book through an organisation like Sonovate, because with these others I've got terms agreed and I've never had a problem with them. Is that possible?
yeah, so it's called selective debtor or selective invoice finance. So what you can't do is, and without going into too much detail, do it invoice by invoice, because Sonovate, for example, we only have one fee, but that encompasses all our products, i.e. the credit control, the credit insurance. If you want our back office provision, it also includes that, which I can go into more detail. But we have other products whereby we don't provide the back office, it's just the technology which integrates your business and the funding. But yeah, absolutely, you can put selective debtors through, but you wouldn't put selective invoices, because clearly if you had client ABC and you put through half your invoices but not the other half of the invoices and they went bust, you wouldn't be insured for half of the invoices. Mm-hmm. And also the credit control and the remittances, where are they paying half the invoices to? A Sonovate trust account. Where are they paying the other invoices to? Your bank account. And it gets messy then. Getting your clients to pay in general is difficult, hence why companies like us exist, but trying to tell accounts payable to pay two different bank accounts is not going to happen.
Okay, yeah, fair point. Thank you. And my observation would be, just to add to that sometimes people can get the finance put in place, but they still don't manage to roll out contract or temporary business successfully. And quite often it's for more operational reasons. So all their sales processes aren't really set up for providing contractors. I came across one business, for example, that was still sending CVs and trying to set up 2 interviews for contractors, and surprise, surprise, the contractors had taken an assignment. Sometimes it's their commission and reward systems as well that aren't geared to reward the kind of behaviours that will instigate a successful contracts business. And so we've got consultants who are saying, well, that's not worth it for the very small return. I'll just carry on focusing on perm work. So some directors in a startup position or micro businesses end up taking finance from friends, or accept offers from let's call them equity providers or even angel investors.
Yeah.
So there are plus sides and downsides, but very often this is an opportunity that just comes and presents itself to a new business owner who may not have shopped the market. So objectively, what are the pros and cons of using those sources in your view?
Yeah, and I will reiterate, it's in my view, because there is no right or wrong, and again, people have their own thoughts and quite strong thoughts on this. Similarly to doing perm and moving to contract, the old saying is, why use your own money when you can use ours? For a very small percentage, given all the funding, potential back office provision and peripheral products Sonovate would offer, why use your own money when you could give that money to another part of the business to scale? You could give it to yourself. Why use your own money when you can use a small percentage fee to have access to a big pot? Taking angel investment, that for me there's 2 reasons you'd do that. Firstly, if it's at the very embryonic stages, do you need a cash injection into your business to set up? So if you haven't come into that scenario with deep pockets yourself, then you may require the funds to do that. But obviously, you're giving away equity, which at a later point you may regret. Taking money from your friends, it's for me like doing business with your friends. I wouldn't really advise it unless your friend is recruitment specific and is offering more than just the pounds and pence into the business.
Such as?
Well, that they are in recruitment themselves, or they are a business leader themselves, or they have got a track. You'd like to think that if your friend has got enough money to invest into you, then there's a reason why. They've been in business, ideally recruitment, but it may be advisory, or it may be anything. And sometimes having somebody non-recruitment in a recruitment company can work, but that's maybe later on in the journey. I think when you're starting out, you need to speak to people who have run recruitment companies successfully, who've taken that leap of faith, and if they are prepared to invest as well, then even better. And also it's commitment for them, because clearly that investment, whilst it's likely they'll get a very good return on it over the years, they may not. There's no guarantee that the recruitment company will be a success. But again, if you're just financing your contract book, then there are providers who will do that very quickly. Sonovate, for example, we don't cap it, so a lot of funders will say you have a facility in place, it takes quite a long time to get set up, and you have to sign reams and reams of documents. Obviously we're all EchoSign, it's all digital, but we don't have a funding ceiling, so the contractor could start on day one with one contractor and in theory could go up to 1,000 contractors, and Sonovate would be funding that contract book. Other providers would have a funding ceiling, or cap as they call it, whereby the funder doesn't want to fund over and above that limit. So let's call it £500,000 for example, which is a good problem to have, let's be honest.
Yes.
For the funder as well, because other funders are charging interest, whereas Sonovate aren't. It's just a service charge. So if another funder increases that funding cap, which can be quite tiresome, and going to credit committees and underwriters to authorise it, obviously with ourselves it's already underwritten, they're going to earn more money. So you question why wouldn't they increase a funding line, because they're going to accrue more interest. So my advice would be, sometimes it's nice to have somebody in the business with you, whether they're putting money in or not. It is a hard task setting up a recruitment company, and sometimes working on your own in that lonely office when you've been used to such a busy environment, where you've come from previously. But if you're going to have somebody involved, do your research on them. You're a recruiter, you spend your life researching people for the right role. Make sure that you research the person that comes into your business.
A good point, well made. I've worked with a number of businesses who've actually had to unpick these kind of arrangements later on. And at the time when you're starting up, any offer of cash that's just going to, make you solvent for that month and literally pay the bills, it can be very hand to mouth in the beginning, can't it? It can seem extremely tempting, and the enthusiastic new business owner is quite likely to say yes to the offer of ready money, but without considering what happens when there's no official input other than the money, when the conditions of that investment aren't actually clarified. And my advice would be, no matter how friendly you are with any angel investor or friend, is actually to formalise what that agreement is, what inputs are expected, what kind of checks and balances can be made, because unpicking those arrangements later on can be really quite an unpleasant and personal experience.
Well, let's remember as well, what's the reason why people are going on their own? Is it monetary? Is it to just go and earn as much money as they possibly can? Is it because they are entrepreneurial and they want to run their own business? Is it because they're sick of working with other recruiters? So, and again, there'll be strong views on this from the audience, I'm sure, but if you're going to give away a small proportion of your business and you're going to get something for that, be it cash and or the right stakeholder in your business, then I think from day one that can be a wise move. As we all know, there are organisations out there that specialise in setting up recruitment companies, but they take a large proportion of equity for that, and to the extent that you can't unpick it because that they are the majority shareholders. So why would you do that? You may as well stay in employment. A good biller can be earning 30% commission plus their salary, so they're probably coming out with around 35 to 40% anyway. So why would you set up on your own and give away over 50% of your company on day one? That, to me, unless there is such a industry specific organisation that is literally going to catapult and scale you, that 50% or whatever it is that you own is worth an awful lot. It's 50% of a lot, but 50% of a new start recruitment company is 50% of not nothing, but not a lot, if that makes sense. So I think what you'd remind yourself of why you're going on your own, and choose carefully if you're going to have somebody with you that it's the right person.
I think that's a really good point. So I have worked with one business where the reason they took that investment was because they had a game-changing idea about an automated system that would give their whole product offering a completely different feel and would make their growth, their scalable growth, so much quicker. But they couldn't fund the initial investment in that development all themselves. So with clear arrangements, that's probably quite a good argument. Would you agree, to take investment?
Yeah, and if you need seed capital for a particular reason to grow the company from day one, then absolutely, and that is a different conversation, I think, isn't it? If there's an absolute desire and objective which needs cash on day one. But if you are a conventional, worked in recruitment, want to go on your own, but you need a few quid because you've been spending it whilst you've been in recruitment, just be careful who you take the money from, and make sure that you're getting something back from it. But if you do take investment and give away equity for it, fine. Plenty of very successful recruitment companies do that. But I would also have an SLA or an agreement on what tangibly you expect to receive from that investor, because you've had your money, so they've ticked that box. They will probably want their money back within 12 to 18 months. They will probably want a form of remuneration ongoing for that. Now, which are all fine, by the way, but what's the agreement that they give you back for that? Because they're not going to come and sit next to you and bill. You don't want them to. Your board meeting consists of you and them, which you can do at cost of coffee kind of thing. So when it grows, now it might be that you don't get anything from them, and that actually in 3 years' time you do have proper board meetings and the investor chairs them, for example. But as long as you agree, because that's, as you say, Alison, once the business starts to evolve and scale, a lot of owners start wishing they hadn't taken the investment, and then asking themselves, well, what am I actually getting from my investor who owns X amount of the business? Yeah,
because you're doing all the work,
yeah,
and a large chunk of the benefit is going to them. So it's important to just be open, have your eyes wide open. So on a very detailed level, some of our listeners will be thinking, okay, so going to an organisation like Sonovate to get some business financing sounds attractive. Step by step, what's involved in onboarding a new client who's, let's assume a micro business?
So from a new start or a micro business, it's very slick. It's all automated. You would speak with the sales representative. Obviously, we'd want to find out about your background, what you're intending to do, who you're intending to work with, the sector that you're working in, who your clients are. So do some kind of upfront due diligence on obviously the agency and the agency owner. We require some mandatory information from you for credit checks, and also to evidence the person is who they say they are, etc. But that's completely standard. But then you would have access within 24 hours to your online dashboard, up to 100% funding of the invoices. A great scenario, assuming that the debtors, clients or customers, whatever semantics you use, are credible, then we will allow up to 100% concentration, i.e. the recruiter has one client on one day. A lot of other funders will say we can only allow 30, 40, 50% concentration. Sonovate want to remove that barrier and say, of course you're only going to have one client on day one. Be great if you don't, if you have two, but it's not that easy. We will, assuming they're creditworthy, fund them at that level, so straight away, not only am I getting the funding, I can have it at that level with one client, and secondly, Sonovate on this product for the new start will also payroll my contractors for me as well. So you get your margin every week and your contractors get paid every week, and all you've done is enter a placement onto your Sonovate portal. In theory, and don't hold me to this, but you could put on a contractor's placement, and let's say it ran for 3 months. And as long as the timesheets, which we provide as well, by the way, the processing of timesheets and the authorising, it's all done through online or via our app for Android or iOS. And the contractor would get paid, and you would get your margin, and you could be sat on a sunbed.
Okay, well, that sounds like a great life.
We even prompt you, Alison, as the 3 months is nearing, to try and extend the contract for another 3 months on the sunbed. So that I mean, and obviously I'm joking. That's not how people would want to scale, but in theory, it does manage the whole back to front office process for you. This product for the new start embryonic agency or micro agency, and takes all that logistical work away from you, because recruiters are billers. They're salespeople. They should be spending their time on the phone doing their BD and placing contractors or perm placements. They don't want to get burdened down with payroll and contracts and processes in detail. Myself included. We're not people who are great at administration, are we?
Okay, so before you onboard a new client, though, you said that this can all be in place within 24 hours, but there must be some kind of audit that financing organisations do on the clients before they take them on. Yeah. So what would that involve?
For a new start, so they would fill out a online Sonovate form. So what's the company? What's the company registration? Are you VAT registered? What are your bank details? Are you a homeowner? We would obviously perform a credit check on them, and look at their debtors. But in that scenario, Alison, there isn't a lot of due diligence we can do. We are obviously promoting that we will fund a new start, but by virtue of the fact it's a new start, there is no historic information to conduct diligence on, really.
Right. So, for example, setting up a business bank account, people ask for 3 years of accounts, but you are a bit more realistic about how that can be done. Yeah. So you're not asking for 3 years of trading history or anything like that.
We know they haven't got it. This product is designed for the recruitment consultant who sat in their office thinking, God, I want to go on my own, but how do I do it? How do I pay people? How do I set up a bank account? What does VAT registered mean? How do I pay? All that is done. We just need to make sure that you are compliant. There's no adverse on the. And when I say adverse, we'll come on to it later on, but serious adverse information on the recruitment owner, that you've got a compliant company. We would like to know things like who is your accountant, obviously, but we don't advise you on who you should use. But yeah, it's a quick process. It's an online process. Right.
So a business owner wouldn't have to provide personal guarantees then?
Not with Sonovate, no.
Okay, all right.
Which is a big barrier to a lot of people, because it's scary. A personal guarantee is what it says. It's against the person, but normally that relates back to whatever assets they have, which is normally somebody's house, and that's when they get scared. So no, we don't ask for personal guarantees.
So you did mention earlier about serious adverse information. Just give us an example of what that would be. Fraud.
If somebody's committed fraud, if they are a serial credit evader. Yeah.
CCJs, those kind of things.
CCJs. I mean, listen. People do silly things in their lives, don't they? It depends what the CCJ is for, and if it's been satisfied. We're not going to condemn somebody if they have had poor credit when they were at university because they were spending too much on their mum's credit card. Okay. But if there is sizable credit risk to us, then of course we've got to take a view on that.
Okay. So this has been the first episode of our season 2 of the Recruitment Leadership Podcast. Nick, thank you very much for your comments, which I'm sure will be an eye-opener for an awful lot of startups and very small recruitment businesses about just how easy it can be to scale their business dramatically. The podcast is produced by Generation Nexus, and contact details for Nick and myself will be available.
You've been listening to the Recruitment Leadership Podcast. If you enjoyed our podcast, please subscribe, review and share so that others can find the podcast too. We really appreciate your support. If you have any questions about the topics covered or wish to find out more about recruitment leadership in Sonovate, please email alison@recruitmentleadership.co.uk, referencing the podcast. We're also on LinkedIn, where you can follow Recruitment Leadership and connect with Alison Humphreys. Thank you for listening, and we hope you join us next time for another episode of the Recruitment Leadership Podcast.